We're getting ready for a 20% or higher fourth quarter. What should investors be doing right now? So we finally got a quarter point cut out of the Fed. You can see stocks are rising, risk assets are rising, and you can see that bonds across the spectrum, across the yield curve, the short and the long end, pretty much fell leading into the cut, and overall yields are down across the curve. And I think that is exactly what we all wanted to see. And so the big question investors have is, why did this cut happen? Powell fold to Trump's pressure like he did in 2019? Or is he really just data dependently reacting to what he sees? And I don't think any of us know the truth. I don't think we can imagine what's really going on inside Jerome Powell's head. And I think it's probably a combination of all of those factors. I think he does understand that he is part of a government entity, even though the Fed is independent. He does answer ultimately to the executive branch in a lot of ways, even though you might disagree with that. And he does answer to the American people, and the American people overwhelmingly were demanding that the Fed ease monetary conditions, not just President Trump and the folks around him. So we know that this was the right thing to do based on how the markets have reacted to Jerome's quarter point move. But more importantly, what the Fed has signaled is what's driving markets. And what they've signaled is that further cuts are very likely. And so if you look at Fed funds futures right now, you'll see that there is a greater than 75% probability of cuts further out. So both in October and in December. And that will make a series of cuts of about 75 basis points. 0.25% really doesn't mean much in terms of making a significant difference in a consumer's financial situation. Because if your credit card rates decline by that much, or your adjustable mortgage declines by that much, you're talking about dollars, pennies, nothing super important. But 0.75% could make a meaningful difference in a middle-class family's debt burden each month. Or it could make a significant difference in someone's purchasing decisions now that they're looking at buying a home, buying a car, etc. So these are all meaningful things for the economy. And here's what else we know. This has taken place in the past. And I think some really nice analogs to this are both 2019 and 1998. And this exact scenario played out, which is super interesting. We had a first cut in September, followed by 2 more cuts in October and December at those meetings. And what happened to markets in 2019 and 1998? Well, in those recent examples, we know that the S&P 500 was up somewhere around 8.5 or 9% in the 19 scenario, and much more than that in the 1998 scenario. And so that only makes me even more bullish. And I think what I've been saying, if you've been watching my videos, I've been saying that we've got a shot at a 15 to 25% year in 2025 on December 31st. And we're already up about 12 or 13%. I think I'm ready to adjust my bias here to an even more bullish bias and say 20 to 30% year from 15 to 25. Because I think the fourth quarter could be explosive, barring some horrible unforeseen calamity. But I think we should all be very, very bullish looking at the fourth quarter. And of course, there are critics and there are arguments to be made against what I'm saying. Inflation, right? Inflation could be a lot worse than I expect. I don't expect inflation to be particularly meaningful going forward, especially with AI taking over a lot of what we do at work in large companies and small alike. But other people argue that I'm totally wrong. And they could be right. I don't have 100% certainty that I'm right, but I feel good about saying that. And when I look at the markets and I look at the breadth of what we're seeing here in September, I see that small caps, the smallest companies publicly traded, and even the mid-sized companies that you might see in the RSP, which is the equal weighted S&P 500 ETF, you can see that the performance of smaller businesses is starting to catch up to the performance of the largest businesses. And to me, what that indicates is that the breadth of this rally and the positive outlook for our economy looking out 3, 6, 9, 12 months, both for small companies, for the consumer, and for mid-size and large companies, is more positive than people continue to expect, and that's what will drive the markets higher. If 2025 is 1998, and we're getting ready for a 20% or higher fourth quarter, and I'm not saying this is a certainty, but it's certainly a very strong possibility, what should investors be doing right now? And the answer is very, very simple. You should have a very growth-oriented portfolio So the S&P 500 is your best bet. Over 40% of it is already dedicated to the largest, growthiest companies in the world. So you've got that exposure built in. And if you want to be a little bit more aggressive, you could buy some QQQ and add that on top of your S&P 500 ETF exposure. Now, where else are risk assets hiding that you want to make sure that you own in this kind of explosive fourth quarter? My expectations are that if we get this kind of rally, I think we should continue betting on the things that have been doing well. So in order to supplement your S&P 500 and your technology or QQQ exposure, you could add a little bit of gold, a little bit of Bitcoin ETF, and maybe even a little bit of Ethereum ETF if you want to have a really nicely supercharged portfolio, very levered to the themes of the fourth quarter. And I think this is really simple for folks to accomplish with just a handful of ETFs. We're talking about QQQ, VOO, GLD, ETHA, and IBIT. What a simple portfolio and completely levered to the themes of the fourth quarter.